This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for today's post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Bill's picture saying, looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory.
EIA printed a drawdown of 451,000 barrels. That was really 2.3 million barrels if you also consider the 1.9 million barrels that was pilfered out of the Strategic Petroleum Reserve this week. That was the 10th weekly drawdown from the SPR at the very time that we were originally promised that the Biden administration would be refilling the SPR. Cushing, Oklahoma, building 1.8 million barrels. The big builds on the board were in finished products. Gasoline building 2.7 million barrels. Distillates building a gigantic 5.1 million barrels. U.S. production ticking up 200,000 barrels to 12.4 million barrels per day. That is a new post-COVID high, and hopefully it's the beginning of a resumption in a recovery all the way back up to our previous record of 13.3 million barrels set prior to the COVID pandemic. We've been wondering whether or not it's possible to get back to that production level. Some people have said it's not. We're finally starting to see signs that that plateau that was forming around 12.3 million barrels is starting to break to the upside. OPEC Plus met this past weekend, announced that they were going to hold their cuts while Saudi Arabia voluntarily cut an additional 1 million barrels per day. So far, just for July. They're not telling what they're going to do, whether they're going to extend it for another month beyond that. The other big outcome from the OPEC meeting was that the United Arab Emirates got a bigger allocation. I think that's going to settle down what may have been some restless nerves on the part of the United Arab Emirates. Maybe they were considering breaking away from OPEC because they thought they weren't being treated fairly. Sounds like they've reached a resolution where everybody's happy again, and UAE is going to have a bigger allocation inside of OPEC. And of course, that will give the United Arab Emirates a bigger allocation, which represents, in effect, a concession from Saudi Arabia. I applaud OPEC and Saudi Arabia for rebuilding spare capacity. We very much need to rebuild spare capacity, and cutting for that reason makes perfect sense to me. But I absolutely do not applaud the tactics that they're using of trying to trick the market. They're, making a press conference announcement saying one thing, trying to fake out traders, and then doing something else at their meeting. Those mixed signals are not helping anything. And frankly, the technique of blaming speculators for volatility in the markets is something that used to be only U.S. government officials were so ignorant as to do publicly, despite the fact that all the research, as well as their own FINRA Series 65 exam question, says the exact opposite is true. Speculators absorb volatility, not cause volatility, and they help keep markets stable and liquid. It's a pity to see OPEC following suit with the ignorance of U.S. politicians and blaming speculators for market conditions, but that seems to be what they're doing. The grown-ups in the room know that the market doesn't function the way that some of the OPEC ministers have been alluding in their recent statements. The rapid retracement of the OPEC pop, that is the gap up open that we saw after that surprise OPEC meeting, it's already retraced all the way back down, well below where it was before the OPEC meeting, and that signals that the market is more concerned about demand than supply.
Eric, I wanted to talk about the technicals. On page 2, we have that chart of oil. And what I highlighted here was the high volume node zones between the $75 to $83 area on crude oil. And that I consider that to be a fair market value zone. And what we see here is that crude oil continues to consolidate below that area. The 200-day moving average is descending down into that $80 area as well. And the way that I'm looking at this is that the bears remain, at least on the short term, in control of this price action with us below the $75 level. The first thing that we'll be looking for is at some point the neutralization of this one-year downtrend with a break back up into that 75 to 80 trade range and potentially set up for a trend shift. But right now, the downtrend of lower highs and lower lows remains intact, and we'll see whether the bulls can neutralize this with a break above 75. Nonetheless, Eric, what are you thinking here about equities?
For at least a couple of months now, I've been predicting a rally to 4309 on the S&P. That's the 61.8% Fibonacci retracement of the overall bear market. And I'm going to count this week's test of 4306. That's 3 points shy of my target. I'm going to count that as a hit since I was filled on my order to short the market just a few points below that technical level. For the record, what I actually sold was the September contract at 4345, taking advantage of contango in the market in order to avoid the expiring contract and short a later expiry from a higher location. Now the question is whether the bear market rally is really going to end as I predicted it would here at the 61.8% fib level, or if it's just going to continue higher. Technical analysis lore says that if it goes much past 61.8%, it's probably going all the way to 100%, meaning new all-time highs. So right now is the time to watch this market and see whether or not we break out above or reject back down below this key resistance level at 4309 on the S&P futures chart. What happens there at 4309 should be the tell for the next leg.
Yeah, Eric, I agree with the overall assessment. There is that big key Fibonacci zone right above at this 4309, and it is certainly a point of high interest. But what I want to focus on is what was actually happening in all of the indices throughout the week. On page 4, I have the NASDAQ, and what we basically saw was a 175 basis point down day on Wednesday that reversed off of the highs. But really, the Russell and even the equal weight indexes have been doing incredibly well in that same window. So on page 5, I have the 1 week index performance, and you can see here that the NASDAQ is for the week been relatively flat. S&P 500 up 200 basis points. But what you can see here is that the equal weight S&P was up 460 basis points, while the Russell was up an extraordinary 881 basis points. The point being here that we've seen a rotation back into these small caps and back into a broader part of the market. And we're seeing a little bit of rotation out of the NASDAQ. And the question I'm trying to answer here is this a new trend? Are we going to see more of this in the weeks to come? Or was this just simply an incredibly stretched situation? And this is all big, mean reverting, quick little moves. On page 6, I have that New York Stock Exchange percentage of stocks above their 50-day moving average. And what we were highlighting weeks ago was that the breadth of the market was just so weak. But what really has happened in this past week was an extraordinary return of breadth. We went from 38% to 68%, almost a doubling of the number of stocks above their 50-day moving averages in just a week. Now, we're not in any overbought territory. Typically, this gets overbought in the 80-plus area, but it is certainly just a really interesting observation because we haven't seen this type of index action for many months. It's really just been that FANG and tech name rally that's been running up until this point. Well, moving on here, Eric, to page 7, I have the U.S. dollar index, and we have that trade range very clearly defined. I remain in the camp that this trade range will remain dominant going into the summer until we finally see some sort of a risk-off impulse that could potentially drive a short-term advance out of this trade range to the upside of the U.S. dollar index, but that's not likely in this current market condition. One way or another, what I'll be watching is whether or not not we fail along the upper boundary and then trade right back to the bottom end of the range. Certainly areas I'm watching are down in the 103 or 102.5 area at the midpoints of the middle of this trade range. What are you thinking here on the dollar?
Well, we were consolidating along at the bottom of the wider long-term consolidation range between 100 and 105. Well, we had a nice rally, and now we're consolidating along again near the top of that longer time frame consolidation range. That could mean that the market is running out of steam and about to roll back down toward the low end of the range around 101, or it could mean that the market is just coiling up for a breakout above 105.5. That's the key resistance level, which is still well above the market, and that's the level to watch for an indication of where the next leg will come.
Finally, I wanted to just touch on the gold. What are you thinking here, Eric?
Well, after testing all-time highs, we came all the way back down to test key support at the 100-day moving average. That's now 1948 on the August delivery contract. We had a nice rally off of that level up to test the short-term moving averages, getting almost back to 2,000, and now we're back down to retest support at 1948. If it doesn't hold, it could be a quick ride down, another $100 to the downside, as the weak hands get shaken out if and when support breaks at 1948. So watch out below if we break below 1948.
Yeah, when looking at that gold chart, we continue to see actually failed rally attempts. So during this period where the U.S. dollar has just been stalling, there's been every opportunity for gold to get a little bit of a kick back north of 2,000. The levels I'm watching for the bulls to beat is this 2,000 to 2,025 area up above. That would really signify that they're going to take another stab at the highs and or even potentially take it to all-time new highs. But every day that passes that we're sitting below this 2,000 level increases the likelihood that this is just a consolidation at a midpoint, and one more quick washout to the downside, like you're suggesting, is potentially on the table. I would still view gold overall very bullish, and so if for whatever reason there was a quick dip down towards 1,800, I would view that as a compelling buy on dip opportunity. But on the short term, we're watching whether this 2,000 level continues to reject all gold advances and whether or not there's one more leg coming.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.